Okay, let's start the session. The title is Investing in Asia, Focus on Resilient Alpha. Good day from London, Shanghai, and Hong Kong. Thank you all audience for your time for the next 45 minutes on our dialogue with two leading managers from China. With Ms. Grace Ng, the head portfolio manager and director for fixed income department for Ping An of China Asset Management Company, Hong Kong, and Dr. Wang Qing, President and Chief Strategist from Chongyang International Asset Management Company. I'm with InvestTown, a London-based China specialist and fund selector. The world is still in one of the greatest public health crises in human history. Since the outbreak of COVID-19 this year, the lockdown forced people to change their life route and model. For Dr. Wang, from equity side, Dr. Wang Qing is the president and chief strategist for Chongyang Investment Management Company, one of the China's top private asset management company based in Shanghai. Chongyang managed $2.5 billion worth of Chinese equity. Dr. Wang has 21 years of professional experience, served as executive position at China International Capital Corporation, Morgan Stanley, and he was economist with IMF. So my first question today will be both on the equity and bond side in alpha generation. In the total investment market now is full of beta products, index tracking, passive, programmed products, including ETF and quantitative products. Why alpha still available in your area, and whether alpha is sustainable, especially in this post-pandemic area? Is it resilient still from China? I know on the equity side, Chongyang is a contrarian value player. For the last few years, in the bond market, value is not a favorable side. So my question to Dr. Wang is how do you extract alpha in your space? Dr. Wang.
Thank you, Shelley. Yeah, it's true. The value investment strategy underperformed the growth investment strategy for quite a few years globally, and it is particularly the case for the U.S. market since the great financial crisis in 2008 and 2009. However, when it comes to China, the pattern is not obvious. In fact, in Chinese market, the value investment strategy actually outperformed growth investment strategy for the period of 2011 and 2018. This is very interesting. I think the difference in between China and the U.S. market in terms of market style, I think may have reflected divergence of bean cycle and liquidity cycle in the two countries. China, as a developing and emerging economy, still have the typical business cycles and liquidity cycles as dictated by the monetary policy. However, in countries like US and even in Europe, those cycles appear to have dampened quite substantially since the great financial crisis in 2008 and 2009. As we all know that in a macroeconomic environment which features low growth, low inflation, and low interest rates, that environment tend to favor growth strategy over value strategy. However, since China still has these typical cycles, and this really leave room for play for the value player. So we believe that value investment strategy still can generate alpha in China, in Chinese market at least. Having said that, given the new normal post COVID-19, there could be some fundamental changes taking place going forward. So we have to be we have to stay vigilant on this front. Try to identify any early signs of potential so-called paradigm shift, if any, going forward. In any case, we believe, at least for now, value investment strategy still going to work in Chinese market. Will be able to deliver alphas.
Thank you very much, Dr. Wang. So from both Dr. Wang and Grace, I understand because the market development itself and your unique position and your understanding your process and people to understand interpreting the market well and the overall microcycles that will provide opportunity for China that's still providing alpha to the investors, domestic and globally. So how can you avoid the risk that people will have lots of questions about the Chinese market? Because it's still in the early stage, still in the emerging market stage of development, itself has a unique pattern of behaviors. Whether the data or information viable or reasonable to understand in a global standard, whether it's trustworthy, and also because the combination of market participants, how can you avoid this noise or volatility in the market? So I will give it to Dr. Wang first to give us your understanding about the market behavior.
Yeah, speaking market behavior, China's onshore Asia equity markets are still dominant by retail investors who are short-term focused, events-driven, and tend to have the mentality of frequent trading. This is the primary reason for the relative high volatility of the share prices, even for those companies, the fundamentals of which are stable and sound. Concerning the quality of information, I think the track record in this regard in China is mixed, reflect inadequate regulatory oversight in general and poor corporate governance in particular. Having said that, those so-called risk factors, in my view, are actually the defining features of emerging markets, and those are actually that's why emerging market tend to have a high risk premiums, and in my view, in fact, those factors, those risk factors and features of Chinese market actually could become very important sources alphas for long-term focused investors who are able to distinguish between signals and noises, who can make investment decision based on fundamental research. Those are the potential issues for emerging markets like China's. But at the same time, if you done your homework, they could become an interesting and important source of excess returns.
Thank you, Dr. Wang. And Dr. Wang, it's very clear the Chinese market is synchronizing, improving, changing. We see the economy of China is already second largest in the world. We'll confidently see that with the market growing, the financial market and the behavior of the market and also the participants, the rules will growing and emerging to the global standard. And for some extent, with the technology support, the data economy will make China one of the very important stakeholder of the regulation, the rules, and the rule book. So I think we can see that day to come. We can benefit the status of emerging market right now, the size of the market, and the pattern of its growth. We can capture the excess return by this process. It's very well. So let me go to the last question to both of you. What is the best investment idea for you post-pandemic for the next 3 to 5 years? And any lesson you learned, whatever the idea you want to share with the audience. Dr. Wang first.
Well, the lesson or experience is that investing in China, one should be always try to be long-term focused and stick to your high conviction ideas that are supported by sound fundamental research. And do not be afraid of missing out opportunities or market rallies in the short run, and those rallies could be quite remarkable in the short run. But the high volatility nature of the market suggests that if you are patient enough, you will, sooner or later you will be presented with opportunities to buy the companies or shares of your choice at reasonable valuations. So to this end, I think one useful lesson or experience is that to be contrarian can oftentimes be quite rewarding. So in this post-COVID era, I think we should recognize the important feature of the economy and the market, that is high quality growth become kind of a rare commodity. At the same time, we're going to continue to live with low rates environment and abundant liquidity slosh around. So in this type of environment, we should really focus on identifying high quality growth companies, and those high quality growth companies tend to enjoy quite some valuation premium. And having said that, I think for developing country and emerging economy like China, the traditional cycles still exist. So we should also to track the different phases of the cycles, and because in different phases of the cycle, be it business cycle or liquidity cycles, and they tend to reflect in the rotation of different sectors in the stock market, and which a pattern tend to be missing from the mature market, but this still exist and prevalent in Chinese market. Those rotation of sectors could create quite a decent alpha opportunities in the short and medium term.
Thank you, Dr. Wang. I'm very convinced from the cycle of the economy and also from the currency perspective. It is really great that there is a long historical cycle in the global economy. For example, 500 years ago, it's the Dutch economy. Then it turned to British. Then it's United States. Now it's a era or age for Asian to rise again. At least it will become a very important part of global investing, and China will leading this cycle as a very important stakeholder. So I think the opportunity is there that if we using the in-depth, long-term, and local lens to interpreting the investment, to interpreting the behavior of the market, we can use this information to make smart investment decision to get a decent return and a decent excess return. So the alpha opportunity is still existing in Chinese market. I think the time is up. Thank you both. Thank you, Dr. Wang. Thank you, Grace, for sharing your view. I think it's about the time for us to turn to the audience for their questions. So let's stay online for a few more minutes to answer their questions. Thank you.